The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
Congress's hearings on digital assets and stablecoins over the past 2 weeks have set the stage for creating a regulatory regime for crypto. It's unclear how things will proceed. Some lawmakers, like Senator Sherrod Brown, criticize crypto for high fees and rehashing our broken banking system. Meanwhile, others, like Senator Pat Toomey, point out that if the United States bans stablecoins, the world will continue to use them and innovate without the U.S. Joining us now to discuss is former CFTC Chair, attorney, and author of Crypto Dad, Chris Giancarlo. Welcome, Chris. Love the holiday ribbon in the background. Happy holidays. So your reaction to congressional hearings.
Holiday cheer. That was such a somber opening, Christine, with Lawrence and Emily.
Exactly. We need it. We've been seeing red candles. We want to see some red ribbons too. Yeah. So your reaction, Chris, to the congressional hearings on digital assets and stablecoins. Where do you stand after, these lengthy hearings?
Well, we've had two now, and first in the House Financial Services Committee, and then last week in front of the Senate Banking Committee. And I'll tell you what I'm hearing, and what I'm starting to see revealed is really almost less than a political divide as much as it's a philosophical divide. And the way I would describe it is there's a philosophical divide ultimately as to who should control access to financial services, who should control access to credit allocation in a deep and sophisticated economy like ours. Somewhere in the middle is those perhaps clinging to the notion that our increasingly concentrated banking industry should remain the guardians of the financial system. And I think to the left of that is perhaps an emerging group that believes there should be increasingly greater political control over that. And then perhaps on the right, or certainly on the libertarian side of that, is the notion that this new innovation can in a more egalitarian way provide access and provide allocation of credit based upon these new protocols, this new Internet of Value that can do so in a way that perhaps is not tied to political influence, but is tied to neutral algorithms and a more of a neutral protocol-based system. And so I think you've really got, I talk about in my book, The Fight for the Future of Money. I think you've got these forces arrayed between sort of embracers of the legacy financial system, which is increasingly concentrated in a few Wall Street banks. You've got those that would perhaps move it more toward political control of that process, which you saw the recent Biden pick for the officer of the controller of the currency. And then I think you've got this new emerging wave, this Internet of Value that seeks to break free of those political and large cap controls toward more of an egalitarian system based upon technology and protocols.
We have this push, of course, to regulate asset-based stablecoins. What would happen if that's the case? Would we see the rise of algorithmic stablecoins even more so and take a larger market share? And would that be actually a bigger threat to the overall stability, both of the cryptocurrency ecosystem and over the overall economy, if algorithmic stablecoins come to the fore and take the place of these asset-based stablecoins? How should they be looked at, and should they be regulated as well?
Well, and that's fascinating, Lawrence, because I think at that hearing and at last week's hearing, sometimes you heard confusion in those that talked about the threats of this new system, confusion between whether it was a threat to the economy or whether it was a threat simply to the legacy financial structure. Let's not confuse one and the other. All new innovations threaten the old guard. Whether that actually arises to a threat to the national economy and to the global economy is a second question. And a lot of times I heard discussion of the threats of this innovation, but they really seem to be threats to the status quo. 25 years ago, when the first wave of the internet came about, that was greeted with an official Washington response that was first do no harm. Now, what I'm hearing in some cases is a policy response that seems to be saying first protect the status quo. That's very much how I read the recent President's Working Group, the PWG report on stablecoins, it pointed out a lot of the risks of this, but its response was, in order to prevent that, we need to defend the status quo. And I think that's a bit of a disappointing response, because just as, yes, this technology will disrupt a good portion of the status quo, it could bring with it a much more open financial system at lower cost, at greater speed, and most importantly, with greater financial inclusion. And so I think we need to be more open-minded in line with our traditional American open-mindedness to technological innovation that's gotten us through the last several decades in such a spectacular fashion.
I guess my question, though, is to the point that if we do get around to regulating asset-based stablecoins, such as USDC and Tether and the likes, that the market might shift to these algorithmic stablecoins, which potentially have those have a different structure to them. And my question is that necessarily is that going to be more, let's say, volatile for the overall cryptocurrency market if we switch from these asset-based stablecoins to the likes of the algorithmic stablecoins? And does that mean that there needs to be a different type of regulation for the algorithmic stablecoins in that case? Or do we just say, you know what, we'll just focus on the asset-based stablecoins, make sure that their assets are whatever they say it is, and get some disclosure on there, and leave those algorithmics alone to explode or prosper or implode, depending on how the market takes it?
Yeah, volatility is something that in my work in the commodity futures markets, we know very, very well. And deep and liquid markets are able to deal with volatility very well. In fact, one of the knocks on Bitcoin is its volatility. And yet you only need to look at the oil markets that were 2 years ago trading at zero or below and are now approaching $80 a barrel to see that we deal with volatility all the time in our markets, and we're able to manage our way through that. So I don't view volatility as of and by itself a basis for suppressing new innovation. What we need to do is build deep, liquid markets, well-regulated markets around that volatility, and we can work with it. Certainly, there's a lot to commend this innovation, but yet volatility, in fact, volatility in a lot of new asset classes is more often the norm than otherwise, and yet our markets can deal with that.
Chris, nice to see you. Congratulations on your book. It's really, really exciting.
Thank you, Emily. It's good to see you again.
I've had the impression I've had the pleasure of hearing you talk about your book a couple times at public events. And, your characterization of this current SEC is as one that's kind of more enforcement oriented and potentially more repressive than SECs of the past. And please correct me if I'm wrong, if that's not your impression, but I'd love to hear you, share those insights with a wider group. Do you think that the current SEC under Gary Gensler is actually tougher or stricter than the SECs of the past?
Well, the phrase I would use is actually regressive. We've got a new innovation that has brought more people into the financial markets with a great deal of enthusiasm and excitement, more so than Wall Street has seen in generations. And yet, the SEC's approach to investor protection is basically to limit market access for the most those innovations with the greatest potential, to limit access to accredited investors, basically wealthy or sophisticated people. I think the math is about 13 million out of 300 million Americans qualify as accredited investors. I mean, that's a tiny sliver, a tiny slice of the American populace that the SEC will allow to access some of the most exciting innovations. I mean, that's a type of a paternalistic investor protection mandate, or at least as interpreted by the SEC. And its approach to enforcement is what some people call regulation by enforcement. That is, that there's no way of knowing how a new crypto might qualify as being subject to the SEC and its investor protection regime, other than at the force of an enforcement action by the SEC. And so I would really characterize the SEC's current approach is unfortunately quite regressive at a time when we've got a new innovation that is bringing more people into financial inclusion. And so in my book, I do recognize there is a need for investor protection. In fact, we were strong on that ourselves at the CFTC. But I think it needs to be done in a way where the SEC itself is innovating. And I think it certainly needs to innovate its approach to investor protection to accommodate more of American citizenry into the financial system and not, in a sense, restricted only to the wealthiest and most sophisticated investors.
So, Chris, thank you for that clear summary. So just to put this in perspective for our audience, I mean, would you say that SEC Chair Gary Gensler, current SEC Chair, is actually more enforcement oriented or cracking down more on crypto than his predecessor, SEC Chair Jay Clayton? I think this is an interesting distinction because Jay Clayton was not known as being particularly friendly to crypto, right? And when Gary Gensler came in, there were sort of high hopes that, okay, he has a deeper understanding of crypto. This might be sort of a new era. Would you say that Gary Gensler is actually kind of tougher on crypto than his predecessor, Jay Clayton?
Indeed. I mean, I think it's unquestionable. Certainly, the aggressiveness under the SEC right now toward crypto is perhaps unprecedented. And I think it goes back to that philosophical divide that I talked about to begin with. I think that Chair Gensler talks about no innovation outside the regulatory envelope will long survive. I think that's on its face, it's a sensible approach. The problem with that is what form of regulation? There's many types of regulation. There's regulation that's inappropriate for a given innovation, and then there's regulation that is appropriate. So the question really is not whether there should be a regulatory regime for crypto. Of course there should be, as there is for all of our financial service activities. The question is it one that's appropriate? Is it one that's well calibrated? Is it one that's well designed? I often push back against the notion that somehow quantity of regulation is a objective. Of course not. It's quality of regulation. The regulation must be fit for purpose. It must be suitable. And what we don't yet have is what is the appropriate form of regulation. And we don't have the SEC putting forward, I think, really appropriate ideas for it, innovative ideas that actually broaden financial access and financial inclusion, and that interpret investor protection as not just applying to the wealthiest in our society, but to all members of our society. That's the type of regulation we've got to get to.
It's interesting you say that because the president's working group has called for comprehensive oversight on stablecoins. They have a 26-page report, and they have numerous policy proposals. Among them, they recommend that stablecoin issuers be insured depository institutions. And so, from what I'm understanding, that you would probably consider this a little more strict than it needs to be. And so where does the, I guess, counter argument to that come from? In terms of creating a very comprehensive report with policy guidelines from a position that wants innovation to flourish?
Well, look, the legacy banking system hasn't crowned itself in glory in terms of broadening financial access here in America or around the world. And yet the president's working group would restrict stablecoin issuance to the legacy banking system at a time when the control of the currency is not issuing an enormous amount of new banking licenses. So I thought Senator Toomey's remarks on this, I think, were well taken. We need to look at this innovation not as something that needs to be repressed or limited to legacy financial institution players. And quite frankly, our legacy financial institution is increasingly concentrated in a small number of Wall Street banks. I think what we need to do is see this innovation as something that could open our financial system to greater access. And so we need to find a way. And I think the president's working group well identified the concerns of stablecoins. I'm not discounting that. And I think my predecessor at the CFTC, Tim Massad, in a recent Brookings Institution piece, did a very good job of identifying those concerns. But at the same time, to Tim Massad's credit, he identified the opportunities as well. My disappointment with the president's working group report was it was strong on all the downside. It really didn't identify much of the upside or how to realize the upside. It was very much a glass is half empty approach as opposed to a glass being half full.
So, I do want to ask you about the difference or what you think would be better ultimately, stablecoin, an economy that's based on stablecoins or an economy that's based on a digital dollar / CBDC. But before we do, about Chairman Gensler, what do you think is holding him back from approving a spot ETF? They approved the futures ETF and everyone says, well, it's time for us to get to a spot ETF. What do you think his concerns are there, and is it justified?
Well, it is. There are legitimate concerns there. As you know, they have green-lighted a ETF based upon the CFTC's regulated market for Bitcoin futures, and that's a market that we started 4 years ago. It works very well. It's well policed. It's well regulated. It's deep. It's liquid, and it's transparent. However, the marketplace has shown a demonstrable need or demonstrable demand for an ETF based upon the cash Bitcoin market. And the reason why I say it's demonstrable is because a number of jurisdictions, Canada and several in Europe, have launched ETFs on the spot market that have drawn great demand. So clearly there's demand. I think the application process here has an 8 or 9 year history at the SEC, and the SEC to date hasn't granted it. Now, I do understand the complications of doing that. The question is, which spot market, U.S. or overseas, will it be based upon? What will be the guardrails? What would be the protections against fraud and manipulation? I think there's a lot to be worked through there. But at the same time, I think the SEC has to be sensitive to demand. And if market participants are able to invest in a basket of cryptos, then I think that provides a degree of protection for them in terms of portfolio balancing. So the real question, again, I keep coming back to this, it comes down to control. Do we have an economic philosophy that says people should be allowed to invest where they wish to invest with an appropriate degree of regulation, but at the same time, does regulation spill over to a type of paternalism that says you're not rich enough to invest in this? You're not sophisticated enough, so we're going to prohibit it to you. And that seems to be the approach to investor protection that's currently emphasized at the SEC. And I think that goes against the grain both of American society, but more importantly, it goes against the grain of this whole new generational interest in crypto, which is giving them access to financial products and services that they've been traditionally excluded from.
So would the digital dollar be, along those lines, would digital dollar be better than a stablecoin economy? Which do you think is the
So Lawrence,
alternative?
I launched the Digital Dollar Project not to advocate for a digital dollar in exclusion to non-sovereign forms of money and payment system, but because we believe that ultimately the United States, along with most of the world's central banks, will eventually adopt a form of central bank digital currency for a whole range of reasons that I describe in my book. I think it's inevitable. And therefore, we wanted to make sure that the concerns of the private sector were incorporated into what eventually comes out of the Federal Reserve. If, and I believe it's a case of when, the Federal Reserve launches a digital dollar, and I could be wrong, but if and when it does, we wanted to make sure there's a body of work there expressing concerns of the private sector. I say in my book, and I say this with great respect to the Federal Reserve, that money is too important to be left to the central bankers. In a free society, free people must have something to say, and especially about issues of privacy and economic liberty. And so we at the Digital Dollar Project have been exploring this. We published white papers. We recently put together a set of privacy principles. And very soon we'll be announcing a number of pilot projects in this area.